But still in the thick of earnings, so let me welcome on board Rahul Mithal, CMD at RITES, joining in on the show right now. Rahul, hi, morning. Good to have you on the show. Thank you so much for your time today. Last quarter, Rahul, you were mentioning about improving in the third quarter as execution ramps up. However, you've recorded a decline across all metrics. Tell me, what were the challenges that you faced in the quarter gone by?
Good morning. Yes, if you compare YOY, yes, definitely there is a dip of about 15 to 16% in both top and bottom line. But if you see sequentially, as I mentioned last time, that in our focus of improved execution, sequentially all parameters Q2 to Q3 have improved. The top line has gone up, the EBITDA has gone up by about 14 odd percent, margins have gone up by about 1%. So this is in line with our improved execution, our focus on improved execution.
Hi Rahul, this is Shrishti also joining in. But if we look at the breakup of your numbers, then the exports did not contribute at all in the quarter gone by. Yes, we do understand that there has been challenges that still persist in your turnkey as well as consultancy segment. But help us with the outlook, Rahul. From Q3 to Q4, how can we see your exports number panning out, and also help us with the order book number as well, because since the order inflow hasn't been that great, but going ahead, should we build on to some expectations on the export side?
So let me first talk about the order book. The quarter three, we received an all-time high inflow of orders. We got about 110 plus orders totaling to 1900 crores, which is about 3 times what we got in quarter two. And in fact, this 1900 plus crores is nearly equivalent to about 2000 plus crores, which we got in the entire previous FY. So that's the kind of huge aggressive order inflows. Specifically into export also, our order book now stands at 1300 crores. So the focus on trying to get an export order in every quarter. Last 4 trailing quarters, we've got a fresh export order book, order inflow. Moving forward, this is the export orders which will start generating revenue in the next FY. You see, export orders need a lead time of about at least 12 to 18 months to start generating revenue, because revenue booking happens in an export order when only the bill of lading is made. So moving forward, sequentially, definitely in quarter four, this trend to continue to try and bridge the overall gap for this FY as close to the previous FY, and definitely in the coming FY to see a very aggressive growth of about 20% plus in the top line.
I do take your point, Rahul, and thank you so much for that understanding. But let me also just touch upon your margin number as well, because it's now slipped down to close to 20%, but 20 to 22% is what you have guided earlier. So given the fact now the export execution will be in play, are we in for some bit of an improvement or any changes in the guidance of the margins you would like to make?
You see, if you see the trend, the EBITDA margins have been in the range of 20%, and the PAT margins are about 15-16%. And that is what I have been saying, that with the change scenario of even this quarter, the 1900 plus crores order that we got, about 60% plus are on competitive basis, including a huge consultancy order in Latin America, in Guyana, about 80 crores plus. So with this increased mix of competitive orders, I would see that the margins would remain in this range. As I mentioned last time, that this is the bottom of the barrel that I see in terms of the margins, and we would be aiming to maintain both the EBITDA and PAT margins in this range in the coming FY also.
Are you feeling the heat of the slowdown in government orders? Because the government capex is low. If it is expected to be low by 1 lakh crore, I'm sure it has affected every sector, including railways, and that indirectly could have impacted you.
You see, as I mentioned, the order in quarter three And our USP being that we do infrastructure consultancy across all areas of infrastructure. So to my mind, I see huge opportunities, both domestic and international. And this trend, in fact, in the 9 months that has gone, we have got a total fresh order inflow of about 4,000 crores at a strike rate of one order a day. So we are maintaining that strike rate, which we achieved a milestone about 4 quarters back of being a one order a day company. And even in the Q4, the month that has gone, about a month, we are being able to maintain that strike rate. So I see huge opportunities available. I don't see really a setback in our orders coming in.
Consultancy business is always a business which is a high margin business, but it's also a competitive business. So what is the competitive landscape like? Are you getting orders because of nomination because you're a government company, or you have to compete from other private players also?
You see, as I mentioned, the fresh order inflow of about 1900 plus crores in this quarter itself, 60% was on a competitive basis. And this is the change which is happening if you compare year on year. Last year, this was in the range of about 50% below in terms of competitive. And this year, it has been on a steady basis, about 60-65% every quarter. So moving forward, both domestic and international consultancy, we are bidding aggressively, and we are continuing to get orders, and the ratio of competitive vis-a-vis nomination is increasing. And that's the reason why the margins have settled down to about 20-odd%.
Rahul, so good to have you on the show today. Thank you so much for taking the time out and helping us understand where RITES is headed next and how the quarter gone by was.
Thank you.
If you like this video, then like, share and subscribe to ET Now.